So, the United States is making a financial move that we really haven't seen in decades. It's this huge, targeted intervention focused on just one country, and, well, the price tag is absolutely staggering. $20 billion. That's the headline number we're talking about. A massive rescue package aimed squarely at Argentina. But here's the thing. This isn't your typical loan or some kind of bailout. Nope. This is a direct intervention in the currency markets. And that's a move with some serious implications. And you know, what really makes this a huge deal is just how rare it is. The US doesn't just jump into foreign currency markets like this. So the fact that it's happening now, that tells you something big, something pretty serious, is going on behind the scenes. So this brings up the two biggest questions, right? First, why is this all happening right now? And second, with all the economies in the world, why the intense focus on Argentina, of all places? We're going to break all of that down.
All right, so what exactly did they announce? Let's start with the breaking news itself.
The heart of this whole deal is something called a swap line. What that means in plain English is that the U.S. Treasury is going to buy up to $20 billion worth of Argentina pesos. The goal here is to basically flood the market with demand for the peso, hopefully boosting its value and calming down all the disruption we've been seeing. And don't get it twisted, the U.S. is signaling that they are dead serious about this. The Treasury Secretary, Scott Bessent, came out and said they're ready to take whatever exceptional measures are warranted. You know, those are really strong words, and they're meant to send a powerful message to the global markets that they're committed.
Now, that term swap line probably sounds like some super complex financial jargon, but the idea behind it is actually pretty straightforward. So, what is it exactly?
Basically, a swap line is just an agreement between two central banks to trade currencies. So in this case, the U.S. is swapping dollars for pesos. By buying up a ton of pesos on this massive scale, the U.S. is essentially creating a huge amount of artificial demand. The theory is that this demand should stop the peso's value from completely tanking.
Okay, so here's how it works in three pretty simple steps. First, the U.S. Treasury goes in and buys a whole lot of pesos. Step 2, this creates a sudden, huge surge in demand for that currency. And step 3, basic economics kicks in. When demand goes up like that, it helps stabilize the value. It's a direct play to put a floor under a currency that's been in free fall.
So this gets us to the biggest question of all. I mean, with all the economic trouble around the world, why put this intense focus on Argentina?
And it's a totally fair question. For a lot of us, Argentina's economy might not seem all that connected to our day-to-day lives. So why is the U.S. government taking such an expensive and direct step to help them out?
Well, according to Gene Ludwig, who's a former top financial regulator in the U.S., it really boils down to a few key things. First, Argentina's economy is just way bigger and more connected to the global system than a lot of people think. Second, its stability, or lack thereof, can create ripple effects for other markets and currency traders all over the world. The big fear here is contagion. If the peso collapses, it could start a chain reaction. So the thinking is, by shoring up Argentina, you're actually protecting the whole international financial system.
But look, a move like this is never a slam dunk. It is a high-stakes gamble, and that raises some really serious questions about the risks involved and if it's the right call.
And Gene Ludwig also points this out. He says this is one of the toughest calls a Treasury Department can make. Why? Because messing with currency markets is incredibly tricky. If you get it wrong, you could actually make things way worse or just lose a ton of money. So you can bet this decision wasn't taken lightly.
But you know, this isn't the first time they've tried something like this. Ludwig points to a similar, pretty extraordinary intervention they did for Mexico's currency a while back, and that one actually worked out pretty well. So the thinking is, this is a calculated, proactive move designed to get ahead of a problem that could become much, much bigger.
So, at the end of the day, the whole strategy is about being proactive. Like Ludwig says, getting ahead of it and showing strength is a good thing. It's a power play, really, designed to project confidence and stability before a crisis has a chance to spin out of control.
Which leaves us with the final multi-billion-dollar question. Is this a shrewd, necessary move to stop a global financial fire from spreading? Or is it just a huge, risky bet on an economy that has historically been incredibly volatile? I guess only time will tell.